Insurance is supposed to make life feel safer. You pay a little, so a large shock does not destroy you later. That is the promise. But for a growing number of people, insurance no longer feels like protection. It feels like another financial pressure. Premiums rise, deductibles rise, coverage narrows, exclusions expand. And the strangest part is this: even when people pay more, they often feel less protected. That is why insurance is becoming unaffordable. Not because the product disappeared, because the risk underneath it changed faster than most people realize. Most people think insurance prices rise for the same reason everything else rises: general inflation, greedy companies, more expensive administration. Those can matter, but insurance is different, because insurance is not just pricing the present, it is pricing future risk. It is a financial estimate of what might happen later, how often it might happen, and how expensive it could be when it does. That makes insurance unusually sensitive. It reacts not only to current costs, but to uncertainty, volatility, legal exposure, repair costs, climate events, healthcare pricing, and the growing size of potential claims. Insurance does not become expensive only because the world costs more. It becomes expensive because the world feels riskier to insure. At its core, insurance only works when risk is predictable enough to price. Not perfectly, but well enough. The insurer needs to estimate how often claims happen, how large they are, how much capital must be held in reserve, and whether premium income can cover that risk over time. That system works best in stable conditions. But when conditions become less stable, insurance pricing changes quickly, because the business is no longer just absorbing accidents. It is trying to absorb uncertainty, and uncertainty is expensive. That is one reason premiums rise even before the average person fully understands why. The insurer is not only reacting to what already happened, it is trying to price what may happen next. One major driver is simple: when something breaks, it costs more to fix. Construction materials cost more, labor costs more, skilled trades are harder to find, supply chains are slower, replacement timelines are longer. That means the cost of restoring a damaged home, replacing a roof, repairing a car, or rebuilding after a loss has risen dramatically. Insurance companies are not only paying for risk, they are paying for repair inflation. And repair inflation is often sharper than normal consumer inflation. So even if the number of claims stayed the same, the cost of each claim can still rise enough to push premiums higher. That matters because people often assume insurance is getting expensive for abstract reasons. Sometimes it is becoming unaffordable for very physical ones. It simply costs more to put things back together. This is where the story becomes much bigger. Insurance works best when extreme events are occasional, when disasters are rare, widely distributed, and not highly correlated. But climate-related events change that math. Flooding, wildfire, storm intensity, heat damage, water stress, regional volatility. The issue is not only that disasters happen, it is that they become harder to model, more frequent in certain places, and more expensive when they do occur. That creates a major problem for insurers, because if too many claims cluster in the same places, or if old models stop predicting future risk well, insurance stops behaving like a normal probability business. It starts behaving like exposure management, and when that happens, premiums rise sharply, coverage gets narrower, or insurers exit altogether. This is not only a housing story. Health insurance faces the same structural pressure. Medical treatment costs rise, drug prices rise, administrative complexity rises, specialist care costs rise, chronic illness burdens rise, and as populations age, the demand for healthcare rises too. That creates the same problem in a different form: more claims, more expensive claims, and greater uncertainty about future cost. So health insurance becomes another place where affordability weakens. People do not just feel pressure at the doctor's office. They feel it before they even use care, in premiums, co-pays, deductibles, and the growing gap between having insurance and feeling covered. That is important, because expensive insurance changes behavior. People delay care, avoid claims, reduce coverage, take more risk personally. That is the opposite of what insurance is supposed to achieve. There is another layer most people never see: reinsurance. Insurance companies insure themselves. They do this because large losses can overwhelm any single firm. So insurers buy protection from reinsurers, who absorb part of the risk. That means pricing pressure does not only begin at the customer level, it moves through the entire stack. If reinsurers raise prices, primary insurers raise prices too. If global disasters increase, capital requirements tighten, or uncertainty rises internationally, the effects flow downward. So a homeowner may feel like their premium rose because of their neighborhood, but part of that premium may actually reflect a global repricing of risk. This is one reason insurance feels so strange to consumers. The bill is personal. The pricing logic is often systemic. Insurance becomes cheaper when risk is spread widely. It becomes expensive when risk concentrates. That concentration is happening in several ways. More people live in exposed regions. Property values are higher in vulnerable areas. Claims are larger when they happen. Repair systems are more fragile. Costs rise faster after major shocks. So even if insured populations grow, the distribution of risk becomes less comfortable. And once insurers believe certain regions, asset types, or customer categories are no longer attractive, the market changes fast. Premiums spike. Coverage is limited. Deductibles rise. Some policies are simply not renewed. That is when insurance stops feeling like a background service and starts feeling like a visible affordability crisis. This is what makes the problem socially important. Insurance used to feel like a background cost. Now it is becoming a recurring budget stress point. Housing already costs more. Borrowing already costs more. Utilities cost more. Food costs more. So when insurance rises too, it does not feel like one isolated problem. It feels like another permanent claim on income. And because insurance is difficult to opt out of entirely, people experience it as semi-mandatory. When premiums rise too far, a dangerous feedback loop can appear. Fewer people can afford full coverage. More people reduce or drop policies. That leaves a riskier insured pool. Riskier pools raise prices further. Further price increases push more people out. This is one way insurance markets become unstable. Not all at once, but gradually. The system starts splitting into those who can still afford robust protection, those who can only afford weaker protection, and those who increasingly go without. That matters for the whole economy, because insurance is not just a product. It is part of the plumbing underneath housing, healthcare, transport, business activity, and personal stability. If that plumbing weakens, many other systems feel the strain too. Once private insurance becomes too expensive or too limited, governments often get pulled in through backstops, public programs, guarantees, subsidies, emergency relief, state-level pools, regulatory intervention. This creates another hidden consequence. Private risk starts becoming public liability. That can stabilize the system temporarily, but it also transfers cost. And once governments enter, the affordability problem does not disappear. It gets redistributed. That is important, because people often think the issue is why don't insurers just charge less? But if the underlying risk really changed, someone still has to carry that cost. If not households, then firms. If not firms, then governments. If not now, then later. The price never truly vanishes. It only moves. Insurance is becoming unaffordable because modern life became more expensive to protect. Homes cost more, cars cost more, healthcare costs more, extreme events cost more, legal liability costs more, recovery costs more, uncertainty costs more. The hidden shift is this: insurance is moving from a quiet utility to an active filter on where and how people live. It shapes where homes are affordable, which businesses remain viable, what care people can access, what vehicles they can keep, and what risks families can realistically absorb. Insurance is becoming unaffordable because the world underneath it is becoming harder to insure, more expensive to repair, more volatile to predict, more concentrated in risk. more dependent on systems that already cost too much. That is the hidden truth. The premium is not only a bill, it is a message about what the system believes the future will cost. And when that message keeps getting more expensive, people are not only paying for protection, they are paying for a world that feels less stable than it used to.